Hi, everybody. And today I want to talk briefly about the Invesco NASDAQ 100 ETF, and the ticker symbol is QQQ. And so this actually tracks the top 100 stocks within the NASDAQ index. And this is a really good ETF. It's performed very well, has low expenses, and that's why it's become such a popular ETF. But real quick, if you haven't hit that subscribe button, be sure to do so. We like to talk about investing on this channel, talk about stock market investing, talk about real estate investing, and talk about how to build wealth for your retirement and pretty much any kind of investing goal you might have. So if you like those topics, be sure to hit that subscribe button and also hit that thumbs up button, guys. I really appreciate it. It helps the algorithm. And anyway, let's get started. So the first thing I want to mention is this chart right here. And this once again, it tracks the NASDAQ. So you have the S&P 500, you have the Dow Jones Industrial Average, and you have the NASDAQ, and specifically the NASDAQ 100, like I said. So here's the chart. Going back to 2009, this was actually trading under 30 bucks per share. And right now the share price is at about 245. So I'm not sure the exact amount. I forget what it was. I think it was like 246, but we'll just say 245. So there's been a significant run in this chart. And so this ETF has just done fantastic. And like I said, the expenses are pretty low. And so it does pay a dividend, a very small dividend of $1.62 per share, which is just 0.67 or 67 basis points. So it has $113 billion of assets under management. So I believe I was reading an article, and I think what the article said was that this is like the second most popular ETF, or one of the most popular ETFs, and for good reason. I mean, it has low expenses and also the track record. I mean, when you go back to that chart, you look at the 2008 financial crisis. I mean, the NASDAQ 100 has outperformed the S&P 500 and the Dow Jones Industrial Average by a significant margin. And so that's why this ETF is so popular, because you're getting access to the NASDAQ index, which historically has outperformed because you have all the tech companies, you have, Apple, Microsoft, Google. You also have healthcare companies, and healthcare is another big sector right now. So that's just pushing this ETF a lot higher. In fact, the NASDAQ actually just hit an all-time high, and we pulled back a little bit since that all-time high, but it hit, I think it was 10,000 on the NASDAQ. But anyway, that's why this ETF is so popular, because it's outperforming the S&P 500 and the Dow Jones dramatically. And so the NASDAQ is where you want to be if you want the most amount of growth. And I think that's going to continue in the long run. When you look at tech, when you look at healthcare, these are two industries that are growing exponentially, especially tech. So, I mean, when you have the NASDAQ 100, right? Like whenever these new companies that are coming up with these innovative solutions, whether it be automated intelligence, whether it be whatever it is, some kind of robotic company that comes up with some kind of innovative solution that saves businesses money, saves consumers time, or whatever it is, that's going to be one of the top 10 companies, maybe like Apple, Amazon is right now. So it's always changing. But the point I'm trying to make is that you're just investing in the future, really, through this ETF. You're investing in the NASDAQ. You're investing in the companies that, in my opinion, are going to be doing very, very well for a long time to come. But yeah, so it's just going over the dividend yield. Like I said, you have the assets under management. So that just shows there's a lot of demand for this ETF, $113 billion worth. That's a lot of money from Wall Street. And so, and like I said, the expense ratio is only 20 basis points. And so it's 1/5 of 1%. That's not bad at all. And so that's something to really consider, because a lot of ETFs that perform very well, I mean, then again, this is an index fund. It's tracking the NASDAQ. But, you have a lot of actively managed funds that are actually performing worse than the NASDAQ, and they're charging 1% expense ratios. So, I mean, there's no point in investing in those ETFs. Now, there is one ETF I mentioned, BST, or the BlackRock Science and Energy Trust. I actually just bought some shares through my 401k yesterday, and it pays a 5% dividend yield. Now, that ETF has actually outperformed this ETF, or the NASDAQ index. So be sure to check out that video. I'll leave the link in the description. if you're interested. It's doing like 20% right now, so pretty good. But I'm going to compare this ETF to the NASDAQ. I'm sorry, I'm going to compare this ETF to the SPY, which tracks the S&P 500, and then the Dow Jones as well. But I just want to go over the holdings real quick. So this is the top 10 holdings. You have Microsoft, Apple, Amazon, Facebook, Google, all these companies that you've probably heard of already. I mean, you have Intel, Nvidia. So these are all pretty big companies. Companies that, yes, they're massive giants, but keep in mind, this is 100 stocks, not 10. So even if there's some up and coming companies that are able to come up with better solutions than these companies, some kind of disruptive technology company, I mean, that could easily take one of the top 10 spots here. So, I mean, it's always changing. I mean, you think about some of these companies like Apple and Amazon are what? Amazon was formed in the 90s. Apple goes back to the 70s. So they're pretty old companies and they've taken a while to get to where they're at. But who knows? I mean, there might be a company out there right now that will be in this top 10 list someday. And so you're getting diversified exposure. But what I will say is that a lot of the gains are from these top companies like Microsoft, Apple, especially Amazon. Amazon's killing it. Facebook, all these stocks have gone way, way up. What do they call that? FANG, Facebook, Amazon, I guess Apple, and then Netflix and Google. So those are like the top companies, the best performing companies. So a lot of the performance of this ETF is based upon those stocks. But I mean, you have 11% in Microsoft, so that's going to weigh heavily on the performance when you have like, what is that? 30% of the portfolios in 5 stocks. But like I said, there's a reason for that. They're the best performing stocks, and they're also the largest by market capitalization. So that's why it's been performing so well. So here is the sector breakdown. And as you'll see, it's 43.79% in technology. And then you have healthcare at 8% on the right side there, little red, or I guess that would be pink. So 8% for healthcare. Purple, technology, 43%, like I just said. Then, the rest of this, you have consumer cyclical, consumer defensive. So defensive stocks like utility companies and things of that nature, 5%. So you have diversification within the NASDAQ. It's not all technology companies, but a lot of it is tech. And so that's what I like about this ETF. I mean, if you're a young growth investor like I am, I would personally own QQQ within a taxable account because it doesn't hardly pay a dividend, right? So you typically don't want to own dividend paying stocks, especially not real estate investment trust within a taxable account because those taxes really do eat away at your returns. And so everything that pays a dividend, I own within my 401k plans. I own within my Roth 401k, Roth IRA, whatever retirement account you have. You want to own dividend paying stocks and investments in those accounts and then focus on growth without dividends and just hold this over the long run because it's going to be treated with a much more favorable tax benefit. I mean, 15% is the long-term capital gains tax. So QQQ hardly pays a dividend. You're not going to have to worry about those dividends being reported on your income and are in your income statement. And so I would just own QQQ. If you want to find an index fund, you're a young growth investor, maybe you're 25 years old, and you're like, man, I just want to start investing. QQQ can be the only one you own, and I think you can do very well in the coming years because, like I said, technology, automated intelligence is going to kill it in the future. And so the NASDAQ is where you want to be for the best returns, in my opinion. And speaking of that, this is going over the S&P 500. So you have the SPY, which is the ETF for the S&P 500, just like the QQQ is for the NASDAQ. So this is comparing the two funds. And so you have the SPY, as you'll see. This is with reinvested dividends. The top chart right there is with reinvested dividends, and then without reinvested dividends. So with reinvested dividends, you end up with 57,461 over the last 10 years in QQQ, and you end up with 34,000, just over 34,000 with SPY. Now, from a total return standpoint, the NASDAQ has killed the S&P 500, 474%, and just 240% for the S&P 500. Now, without dividends reinvested, you have $54,123 for QQQ, and you have $31,394 for the S&P 500. And this is just going, once again, a hypothetical $10,000 investment made 10 years ago. That's how much it would be worth today. Now, from a total return standpoint, without reinvested dividends, you're looking at 441% for QQQ and 213% for the S&P 500 or SPY. Now let's look at the Dow Jones Industrial Average. So this is actually done worse. And so the total return, once again, we just went over that with the QQQ. As you'll see, it's just killing the Dow Jones Industrial Average. You have just a 215% return for the Dow Jones with dividends reinvested, and then you have 190% return without dividends reinvested. So the worst performing index has been the Dow Jones. The second worst, or I guess you could say the second best, or right in the middle, would be the S&P 500. And the best by a long shot has been the NASDAQ. And like I said, I think that's going to continue because when you look at, like, for example, the S&P 500, they have a lot of retail stocks in the S&P 500. Whereas if you looked at the, let me go back, look at real estate, for example, commercial real estate. There's hardly any commercial real estate within the NASDAQ. Maybe one stock, what is that, 25 basis points versus the S&P 500 versus the Dow Jones, or especially the S&P 500. I mean, you're really into commercial real estate and retail with the S&P 500. There's a lot of retail companies, brick and mortar retail stores. So that's going to be a downward sloping trend. And that's why I think the S&P 500 is probably going to underperform in the coming years, while the NASDAQ is going to kill it because you have 43%, 44% of the stocks within the NASDAQ 100 are technology stocks. And like I said, and I'll keep on saying it, it's going to be huge. It's going to continue to be huge. All these automated intelligence stocks, whether it be driverless cars or new revolutionary holographic cell phones, who knows what they'll come out with. The point is, I really like the NASDAQ. I think that's what you invest in if you're a young growth investor. And I think, unless you're focused on income, that's a different story where you're like getting ready for retirement or you're retired. I would definitely buy QQQ for your portfolio if you just want to buy a passive index fund. Forget about SPY, forget about the Dow Jones or the DIA. Just buy QQQ and just hold it for the next 30 years. And I think you're going to be setting yourself up very well. But anyway, guys, that's it. I want to thank you for watching this video. Once again, if you just hit that subscribe button, I'd really appreciate it. It helps the algorithm. Also hit that thumbs up button. Please share this video with one person and get the word out. And I'll see you guys in the next video. Thanks.